What's going on, everyone? Welcome back. Patrick here. Moving on to the next topic in financial accounting. We're now going to talk about prepaid expenses in this video. And we've actually already covered prepaid expenses in previous examples and within other videos. But in this video, we're going to solely focus on them and go into a little bit more detail. And to start off, I actually want to talk about expenses in general first and how they come about. And to do that, I want to start off with the question of when will an expense be incurred? So we're going to go over all the cases in which an expense can come about, and we're going to start off with the question, when will an expense be incurred? Well, there's actually two possibilities. Either you're going to incur it now, and when I say now, as I mentioned in previous videos, what I mean is whatever period that you are looking at, this period. So whether that's a month or a year, now means whatever period you're looking at. So either you're going to incur the expense now in this period, or you're going to incur the expense in the future, in a future period. And then in both of these cases, what can happen is, let's say you incur an expense now. Well, either you can pay for that expense now in that period, or you can pay in a future period. Either you pay for the expense now that you incurred, or you pay for the expense that you incurred now in a future period. And then if an expense is incurred in the future, well, there's two possibilities for this as well. Either you can pay now for that expense that you're going to incur in the future, or you can pay in the future. And we're going to go over these four cases in more detail. We're going to have specific examples for each. But prepaid expenses, out of all these four cases, they come about in this case over here. Prepaid expenses are here. So they're basically expenses that you pay for now in this period, but you're going to incur them in the future. Now, if you remember from the accounting fundamental videos, when we talked about expenses, when we first brought them up, we said for an expense to exist, it has to be incurred now. And so notice for an expense to actually come about, it can only come about in this area over here. So over here, if you incur an expense now in the period, then it gets classified as an expense. That's the only way that an expense can come about, if it's used now, if it's consumed now, if it's incurred now in the period that you're in. And so with that, that means that any expense incurred in the future, you can't classify as expense yet. Because for it to be classified as an expense, it's got to incur. You got to incur it now in the period. So any expense that's incurred in the future, you can't classify as an expense yet. And so all of this area can't be an expense yet. So what does that mean? That means that prepaid expenses are actually not expenses yet. All right? I know that sounds a little bit confusing, but prepaid expenses, they're actually assets. And then later on in the future period, when they're actually incurred, then they become expenses, right? So prepaid expenses, they're not expenses, they're actually assets. And usually in financial statements on the balance sheet where assets are, it's going to be a little bit more specific, so it will say something like prepaid rent or prepaid advertising or prepaid insurance, right? Prepaid expenses is a little general, but if you do run into this terminology, prepaid expenses, that's not an expense, it's an asset. So you got to remember that. And I'm going to go over in more detail why it's an asset once we get into some examples. But just know that anything in this area here, if it's an expense is incurred in the future, can't be classified as an expense yet. For it to be classified as an expense, you have to incur it now in the period that you're in. And so what I'm going to do is I'm going to number these cases. So this here is going to be case 1. This here is going to be case 2. This is going to be case 3. And then that's going to be case 4. And we're going to go over examples. Before we get into the actual examples, what I want to do is kind of just generally go over each of these cases in terms of what happens with that accounting equation. So I'm going to write out that accounting equation that we've been using for the double entry accounting. So change in assets equals change in liabilities plus change in capital plus revenue minus expenses minus dividends. So in this first case, you incur an expense now and you pay for it now. Well, if you're paying for it now, it means you're paying for it with some kind of asset, and it's usually cash. So assets are going to go down, and it's mostly going to be cash in most cases. So you're going to have a minus in assets, and it's going to be the cash account. And then you're incurring the expense now, so you're going to have a positive right there. And then a minus positive is just a minus overall. So notice that this left side and then the right side is balancing. And that's going to be some kind of expense that you're going to incur. Whatever it is, whether it's an advertising expense, supply expense, it's going to be some kind of expense. So this here represents this first case. And this transaction here is happening right now in this period. Now, what about this second case? If you're going to incur an expense now, but you're going to pay for it in the future. Well, you incur the expense, so you're going to have an expense there, but you're not paying for it yet, meaning that you have to pay for it in the future, so you're going to have a liability over here. So notice we have a positive here on the right side, and then we have a negative positive, which is just a negative overall on the right side as well. So those would net out to 0. Right? So if you're paying for something, let's say with a credit card, then you're going to have an accounts payable, and then that expense is going to go up because you incurred the expense now in the period. So that's the transaction that would happen this period. And then in the future, you have to pay back this liability. So when you do, you'll be using cash usually. So that would be minus, and then this would be minus here. The liability is going to go away, and you're going to pay it with cash. And this transaction is going to happen in a future period. So this whole scenario here, these two transactions, this transaction's happening now, this one in a future period. It could also actually happen in the same period, potentially. But let's just pretend it's going to happen in a future period. So both of these transactions here represent this second case. Now, the third case, which is what this video is mostly based on, you incur an expense in the future, but you pay for it now, right? Which is a prepaid expense. So what's going to happen in this case is right now you're going to pay for it. So your cash is going to go down. And then you're going to receive an asset. So assets go down in one account, but then they go up in another account, and the account they go up in is a prepaid expense. A good example of this from previous examples is when we were buying flyers to advertise. When we first bought the flyers, we spent cash, and then we had flyers as an asset. and that was like a prepaid expense. And then once we distributed the flyers, then this account, the flyers asset account, went down, and then we incurred that expense. So this is going to happen now in this period for case 3. And then what's going to happen is as that expense gets incurred, that prepaid expense account, that asset account, is going to go down. And then you're going to have an expense that gets incurred. Right? So you have a minus on the left side and then a minus on the right side. A minus positive, which is just a minus. Right? So this here would happen in the future period. So this would be now, and then this would be in a future period, and both of these transactions represent case 3. And then case 4, if you think about it, there's no real transaction to put because you're going to incur the expense in the future, and then you're going to pay for it in the future. And so once that future period comes, basically this case would become this case over here, where you incur the expense now in this period, and then you pay for it now. Right? So there's nothing really to go over with this 4th case, but I still just put it down just so you could have an overall visual of what is happening.